Welcome back. For the final time, you've built a fortress of stability. You've learned to command time. Now, we face the final, most thrilling challenge. Mastering innovation risk. Sticking only to what's safe guarantees you'll miss the next exponential wave of growth. This episode is about deliberately engineering a part of your wealth to capture the massive, non-correlated returns of radical innovation. First, let's talk about Pillar 1, the Innovation Allocation Rule. Innovation is, by its very nature, incredibly risky. This is exactly why the barbell strategy we discussed back in episode 16 is so critical. Our goal is to unleash the full potential of your 10% moonshot fund while keeping your 90% safety net absolutely secure. Within that moonshot fund, we're going to apply the 5% rule. You'll create a sublocation, let's say 5% of your total net worth, dedicated specifically to high-risk, unproven technologies that could rewrite the rules of the global economy. Think of this as your future fund. The key here is the non-correlation mandate. These investments must be structurally disconnected from the rest of your portfolio. When your index funds are having a great year, these early-stage ventures might be down, and that's okay. When the public markets are struggling, this is where your real upside could ignite. This is what true diversification looks like at an advanced level. Now, for Pillar 2. The 2 innovation channels. How do you actually tap into this innovation? There are 2 main paths, and both require the high soft leverage we covered in episode 15. The first path is direct venture investing. I call this being the builder. This is where you use your 1% upgrade skill to identify and invest directly in early-stage startups that fall squarely within your circle of competence from episode 26. Yes, it takes more work, but it cuts out all the middleman fees and gives you far greater control. You're making a direct asymmetric bet on a specific team and their technology. Your real leverage here isn't just your capital. It's your value add. Your mentorship and strategic advice can be even more important, helping you secure equity on much better terms. The second path is specialized fund investing, or being the scout. This involves investing in top-tier, highly specialized venture capital funds. I'm not talking about general tech funds. I mean funds that focus on incredibly narrow, deep technological themes, things like synthetic biology, quantum computing, or next-generation AI infrastructure. This approach diversifies your high-risk exposure across multiple ventures and gives you access to deals you could never find on your own. But a word of caution, you must do your homework. Ensure the fund manager's interests are perfectly aligned with yours and that they have a proven track record of capturing true, game-changing asymmetry. Finally, Pillar 3 is all about managing the long horizon. Innovation is not a get-rich-quick scheme. It's a long game, often taking anywhere from 7 to 15 years to see a significant exit. The volatility along the way will be extreme. This brings us to the patience protocol. The moment you invest capital into your innovation fund, you must mentally write it off. Consider it spent. This simple mental shift is powerful. It eliminates the emotional temptation to panic during the inevitable downturns, and perfectly aligns with the discipline paradox from episode 17. But patience does not mean ignorance. You still need a process for continuous review. Use your 5-hour rule to constantly track the core technological breakthroughs and regulatory changes affecting your chosen sector. Revisit the active obsolescence test from episode 23 to make sure the fundamental thesis for your investments still holds true. So, here is your final action step for this series. Define the exact dollar amount of your 5% innovation fund. Then, I want you to identify one deep technological sector, something beyond just tech, that you genuinely believe will fundamentally reshape our world in the next 2 decades. This is the final piece of the puzzle. This is how you transition from just preserving wealth to actively shaping the future. You've learned to embrace innovation risk and fortify your wealth against internal threats. Now, it's time for the final layer of defense: macroeconomic intelligence. This is your ability to read the global, interconnected signals that come before major market shifts. We're graduating from simply reacting to headlines to building a predictive framework for global finance. Let's start with Pillar 1. The 3 macro watchtowers. Instead of drowning in thousands of data points, we'll focus on 3 key indicators that have historically signaled major economic turns. First, the bond market. This is where the smart money operates. The yield curve, which is the difference between short-term and long-term government bond yields, is a powerful recession predictor, often better than the stock market. Your action is to understand what an inverted yield curve means. When short-term rates are higher than long-term rates, it signals fear and a potential economic slowdown. When you see this, it's a clear signal to increase your cash bridge. Second, the copper-to-gold ratio. This is your growth signal. Copper, often called Dr. Copper, is used everywhere in industry, making it a proxy for economic growth. Gold, on the other hand, is a hedge against fear and instability. So, when the ratio of copper's price to gold's price starts falling, it tells you that confidence in future growth is declining and fear is on the rise. This is your cue to strengthen your inflation-proof core and adopt a more risk-off position. Third, the currency market. This tracks capital flight. When risk increases, global capital moves quickly to find safety. Your action here is to monitor major currency movements. If you see sudden, aggressive strengthening of traditional safe haven currencies like the US dollar, the Swiss franc, or the Japanese yen, it often signals a global deleveraging event. This is a risk-off move that frequently precedes stock market volatility. Now, for Pillar 2, the second-order thinking filter. Amateur investors react to the immediate consequence of news. For example, the Federal Reserve raised rates. But as an architect, you anticipate the second and third-order consequences. Let's take a real-world example. The price of energy, like oil and gas, rises. The first-order effect is obvious. Higher prices at the pump. The second-order effect, higher manufacturing costs, and, because of transportation, higher food prices. This means inflation is picking up, but the third-order insight, the architectural insight, is this increased stress on consumer budgets leads to less spending on non-essential items. This will negatively impact high-growth consumer stocks. At the same time, it makes your inflation hedging real assets much more attractive. Here's the fix. Every time you hear a major economic headline, force yourself to identify the third-order consequence. Then, adjust your allocation matrix accordingly. This is how you move from reacting to anticipating. Finally, Pillar 3. Global portfolio immunization. You'll use your newfound macro intelligence to shield your core wealth from systemic shocks. The rule is simple. When global uncertainty is high, you need to increase your holdings of assets that have a negative correlation with global stocks. What are these assets? They are your lifeboats when the global ship starts taking on water. Think short-duration U.S. Treasury bonds, hard assets like gold, and even specific, non-correlated digital assets. These are designed to hold their value or even rise when everything else is falling. So, here is your action step for this critical episode. Your mission is to find a simple, automated source for tracking our 3 macro. This could be an economic dashboard, a specific app, or a reliable newsletter. Once you find it, integrate this check into your weekly Clarity Hour review. This single habit will transform your ability to navigate the complex world of global finance. By mastering these 3 pillars, you're not just protecting your wealth. You're building a system to see the future more clearly than anyone else. You've journeyed through the entire curriculum, from the initial blueprint to the global intelligence. You're not just an investor anymore. You've become an architect of wealth, time, and intent. This final episode is the zenith, the peak. It's a synthesis of the highest level principles you need to maintain a life of perpetual, purpose-driven freedom. Let's begin with the 3 laws of perpetual wealth. These are not just strategies. They are timeless laws that go beyond market cycles and technological shifts. They define the mentality of enduring success. First, The law of asymmetric patience. Here as the truth most people, unaccept. The majority of your financial life must be boring. It's about sticking to the core compounding principles we discussed and the value doctrine with extreme, almost fanatical discipline and patience. Then, and only then, you act decisively when a genuinely asymmetric opportunity appears within your circle of competence. Your action ratio should be 99% patience and only 1% calculated aggression. It's about waiting for the perfect pitch, not swinging at everything. Second, the law of defensive learning. Never, ever mistake your current success for permanent knowledge. Your greatest defense against becoming obsolete and against your own cognitive biases is the rigorous, relentless pursuit of new knowledge. Remember the 5-hour rule? That's your shield. The moment you stop learning, your entire wealth system begins to decay from the inside out. Complacency is the enemy of perpetual growth. You must remain a student for life. And third, the law of self. Your greatest risk isn't in the market, it's internal. It's you. You must continually audit your health, your relationships, and your sense of meaning. These are the pillars that support everything. Use the wealth you've built to remove friction from your life, to buy back your time, and to maximize your moments and flow states. Never forget, your happiness and well-being are the ultimate return on investment. What's the point of a massive portfolio if your life is empty? This brings us to the final protocol. The unwritten chapter. The entire purpose of building this system was to create one thing up. It's the freedom to choose what you do next. Now that your financial script is complete, your focus must shift entirely to the unwritten chapter of your life. This is where the time billionaire mandate comes in. You must ruthlessly protect your time. It is your most finite and precious resource. Your final act of leverage isn't financial. It's dedicating your peak energy hours to your highest purpose. This could be your family, your art, your contribution to the world, or solving the very problems that define your legacy metric. And as you write this chapter, you must apply the integrity filter. Your reputation and your integrity are the only assets that can never be insured or repurchased once lost. Guard them fiercely. They are the foundation of your soft leverage, your network, and the true, lasting substance of your legacy. People will forget your net worth, but they will remember your character. So here we are. At the end, you started this journey with a North Star, a single point of light, that freedom figure you aimed for. But you end this journey with a Southern Cross, a multifaceted constellation of purpose that guides not just your finances, but your entire life. The system is secure. The knowledge has been transferred. The path is clear. You are the architect. Now, go and build your cathedral. You've built it. The ultimate financial machine. Your allocation matrix is perfect. Your discipline is unwavering, and your systems are automated. You've engineered a fortress of wealth. But what happens when the enemy isn't outside the walls, but inside your own head? Life's final test isn't market crashes. It's how you handle the volatility you simply cannot control. Today, we're installing the ultimate operating system for your mind, the Stoic Protocol. This isn't about philosophy class. It's about applying ancient wisdom to achieve emotional invincibility in modern finance. First, let's talk about the core principle, the dichotomy of control. The Stoics divided the world into two simple categories: things we can control and things we can't. What can you control? Your thoughts, your decisions, your effort. What can't you control? The market. Interest rates, what some analysts on TV says, or what other investors do. Almost all financial anxiety comes from obsessing over that second list. The fix is something I call the daily control audit. This means you must focus on your process, not the outcome. Your goal isn't to get a 15% return this year. That's an outcome you don't control. Your real goal is the perfect execution of your system. Remember the discipline paradox from episode 17? Did you stick to your allocation matrix today? Did you execute your 5-hour rule for learning? If you answered yes, then today was a total success. no matter what your portfolio's value did. Here's your action step for this pillar. The next time you feel that wave of financial stress, grab a piece of paper, list 3 things causing the anxiety. Now, circle the ones you can actually control. Maybe you can't control a stock's price, but you can control your reaction to it. You can control whether you panic sell or stick to your plan. As for the items you didn't circle, mentally discard them. They are outside your influence, so spending energy on them is a waste. Next up, Pillar 2, premeditation of adversity. The Stoics would mentally rehearse the worst-case scenario. This wasn't to be gloomy, it was to be prepared. It's about robbing the future of its power to shock you. If you've already walked through a 30% portfolio crash in your mind, when a real one happens, it feels familiar, not terrifying. The fix here is what I call the annual financial rehearsal. Once a year? You need to dust off your crisis protocol from episode 24 and review your scenario modeling from episode 34. Go through the simulation, reaffirm that your financial firewall and your deceleration strategy are strong enough to handle a serious prolonged downturn. Part of this rehearsal is applying what I call the emotional discount. You need to mentally accept the potential for loss. Acknowledge that your moonshot fund has a non-zero chance of going to zero. By emotionally prepaying this price, you eliminate the surprise factor that triggers panic selling, which we covered back in episode 12. You've already faced the worst in your mind, so you can act with logic, not fear, when things get real. Finally, Pillar 3 is embracing the impermanence of wealth. Deep down, we all know that assets, money, and even life itself are temporary. It's our attachment to a specific net worth number that fuels our anxiety. The fix is to shift your focus from extrinsic value, the market price, to intrinsic value, which is the real-world utility and meaning you get from your assets. This is about your house isn't just a number on a spreadsheet that goes up and down. It's a home where you build memories. Your business isn't just a revenue-generating machine. It's a source of purpose, innovation, and jobs for your community. Focus on that utility. This brings us to the final test. What truly endures? Not your stock portfolio. As we've discussed in episode 28, it's your legacy of experience. It asks the quality of your relationships we explored in episode 36. Those are the only assets that KUENP wiped out by a market correction. So here is your final action step for today. I want you to identify one piece of financial news that is currently causing you stress. It could be about inflation, a specific company, or the global economy. Now, apply the dichotomy of control to it. What is the very next controllable action you can take within your system? Maybe it's reviewing your allocation, or maybe it's doing nothing because your system is already prepared. Focus only on that action. Ignore the uncontrollable noise of the market outcome. That is how you master your internal world and become truly invincible. Final step in architecting your financial fortress. You've mastered the Stoic protocol. You've secured your foundation, but now we're moving beyond assets. We're graduating to the single greatest driver of asymmetrical wealth on the planet, human capital. This is about investing not just in what gets built, but in the people who build it. Let's start with Pillar 1. The talent filter. In today's world, everyone has access to the same information. The real difference between $1 billion success and a spectacular failure isn't the idea, it's the team. So, for every high-risk, moonshot investment you consider, you need a ruthless due diligence process focused entirely on the people. Is the founder incredibly competent? Are they coachable? Open to feedback? And most importantly, are they relentlessly persistent? Think back to our inner game attributes. These are non-negotiable. Always prioritize a proven track record over flashy hype. I'd rather bet on a team that has failed spectacularly and learn from it than a team with a perfect but untested plan. Failure builds resilience and invaluable experience. Next, Pillar 2. Global skill arbitrage. True wealth isn't just about earning more. It's about creating leverage. And the most powerful lever you have is the global talent pool. You can create immense value by tapping into skills where they are abundant and affordable and applying them where they are scarce and expensive. The strategy is to optimize your remote value chain. This means you outsource the commodity. Tasks, the repetitive, low-friction work like data entry, basic coding, or customer support. Delegate these to skilled individuals in lower-cost regions. This instantly boosts your profit margins and, more crucially, frees up your most valuable asset, your time. Your role is not to be the laborer. It's to be the architect, the conductor. You retain control over the core strategy, the brand, and the intellectual property. You make the high-level decisions while your global team executes. This brings us to Pillar 3, the mentorship multiplier. Investing in people is a two-way street. It's relational, not just transactional. First, there's traditional mentorship. You provide capital, connections, and wisdom to rising stars. This isn't just charity. It builds your legacy and expands your network of influencer soft leverage. But here's the game changer: reverse mentorship. You must actively seek out younger, high-performing individuals to be your teachers. They can bring you up to speed on emerging tech like AI and blockchain, or shifts in culture and market trends that you might miss. This is your ultimate insurance policy against becoming obsolete. You learn from them. They learn from you. It's a powerful, symbiotic relationship that keeps you at the cutting edge. Look at the giant companies like Google or the world's top hedge funds. They pour enormous resources into attracting the top 0.1% of talent. Why? Because they know that one genius innovator can generate returns that eclipse the output of 100 average performers. You need to apply this exact same mindset to your personal network and your investments. It's about quality, not quantity. Your network should be a curated collection of exceptional individuals who challenge and elevate you. So, here is your final critical action step for this series. Your mission, should you choose to accept it, is to graduate from a passive investor to an active architect of human potential. This week, I want you to identify one high-performing person who is an expert in a field you know nothing about. Maybe it's decentralized finance, maybe it's synthetic biology, maybe it's the creator economy. Reach out to them. Don't ask for anything. Instead, offer value first. Schedule a brief call to learn from them. This single action is the first step toward building your ultimate competitive advantage. You've journeyed through every level of financial design, from the foundation to the spire. Now, we arrive at the final synthesis. The ultimate level where we integrate the three greatest tools in your arsenal: systems, philosophy, and people. This isn't about building more. It's about ensuring your creation endures, providing holistic well-being, and preserving wealth through the inevitable shifts of time. This is where the architect becomes the steward. First, let's talk about Pillar 1, your systems. The world is in constant flux. A static system is a dead system. Your financial fortress must be actively adaptive. This requires a non-negotiable audit, which I call the quarterly triumvirate check. This ensures your three core defensive systems are always current. First is tech resilience. Every quarter, review your AI and automation tools. Are they still the most efficient way to manage your data and maximize your output per hour? If a better tool exists, upgrade immediately. Don't let sentimentality for old software compromise your efficiency. Second is macro resilience. Review your three macro watchtowers, your key indicators for the global economy. How are they performing? Based on current bond yields and currency signals, is your inflation-proof core still robust? The key here is to react to fundamental data shifts, not sensational media headlines. Panic is for amateurs. Architects respond to data. And third is legal resilience. This is a quick check-in with your tax strategist. Are your dynasty trusts and other legal structures still compliant with the latest changes in international tax law? A simple conversation can save you from complex problems down the road. This quarterly check keeps your operational framework sharp and responsive. Now, let's move to Pillar 2. Philosophy. The most robust system in the world is useless without the right mindset to operate it. This is where the daily practice of contentment, guided by Stoic principles, becomes critical. True freedom, remember, is not the abundance of possessions, but the absence of craving. To cultivate this, we implement the value, not cost mandate. This starts with active gratitude. Every single day, take a moment to acknowledge the intrinsic value of what your wealth has secured to your health, your relationships, the freedom to control your own time. These are the real assets, not the fluctuating market cost of your portfolio. Next is the experience allocation. Take a hard look at your spending. Is it prioritizing experiences over mere consumption? A luxury car depreciates the moment you drive it off the lot. But the memory of a journey with loved ones? That's a non-depreciating asset that compounds in value over your lifetime, strengthening bonds and enriching your soul. Experiences build your life's true balance sheet by focusing on intrinsic value and memorable experiences. You anchor your happiness in things that market volatility can never touch. Finally, we arrive at Pillar 3. People, your greatest legacy isn't the money you leave behind, but the wisdom you transfer. And your greatest defense against your own obsolescence is the feedback you receive from the next generation. This is about creating a powerful mentorship feedback loop. We do this through 2 actions: the reverse audit and strategic giving. First, reverse mentorship. Schedule dedicated time to receive strategic input from high-performing younger talent. Let them challenge your assumptions. Let them stress test your most leveraged assets and business models. Are you really immune to disruption? Their perspective is an invaluable hedge against stagnation. Second, strategic giving. Your philanthropy should be as rigorous as your investing. Don't just write checks. Engage deeply with your philanthropic vehicles. Demand impact metrics. Apply your core principles of value and asymmetric thinking to your giving. Invest in scalable solutions that address root causes, not just charities that offer temporary relief. Your capital can change the world, but only if you direct it with the same intelligence you use to acquire it. This is the ultimate loop. A continuous cycle of auditing and adapting your systems, deepening your philosophy, and engaging with people. This is what keeps the fortress secure, the legacy meaningful, and the architect not just wealthy, but truly fulfilled. The process itself becomes the final, most valuable product. Congratulations. You've journeyed through the entire curriculum. You've mastered the technical skills, the strategies, the frameworks. But now, you face the final, modern challenge. Information overload. It's a relentless tsunami of data, news, and noise that paralyzes decision-making and erodes your cognitive performance. Your greatest defense, your strongest moat, must now be psychological. This is about building the filters to protect your most valuable asset. Clarity of thought. Let's start with Pillar 1, the Noise to Zigna filter. The vast majority of financial and political media isn't designed to give you actionable intelligence. It's designed to provoke an emotional response. It activates your fear and your greed, pushing you toward bad decisions. The protocol to fight this is the 3-source rule. You need to restrict your consumption of high-stakes market-moving information to just 3 high-quality, non-emotional sources. Think central bank reports, specialized industry white papers, or validated global economic data feeds. What do you eliminate? All of it. Cut out the cable news, the non-specialized financial blogs, and especially the social media commentary about market movements. This is how you stop the herd instinct from overriding your rational mind. You must focus on policy, not personality. Concentrate on the slow-moving, actionable changes like interest rates, regulation, and taxation, not the fast-moving opinions of market-talking heads. Next is Pillar 2, the Decision Automation Shield. Cognitive fatigue is real, and it leads directly to poor decisions. The more choices you make, the worse those choices become. The solution is to reduce the number of decisions you have to make every single day. The fix for this is what I call the sit and forget mandate. You need to automate every decision that isn't high leverage and start with your portfolio. Automate your rebalancing so it happens on a fixed schedule, taking the decision completely off your plate. Do the same for your savings and investments. Make sure your investment fuel is auto-debited and allocated instantly without you lifting a finger. And this extends to your lifestyle. Automate low-value personal decisions. Things like meal preparation, wardrobe choices, even your daily commute route. Every ounce of mental willpower you save on these small things is preserved for the high-stakes capital allocation decisions that truly matter. Finally, we have Pillar 3. The mental decompression protocol. Your mind, just like your portfolio, needs periodic decompression. This is essential for the deep work of synthesis and insight. The fix is mandatory cognitive rest. You must dedicate unscheduled time to activities that force your brain into a state of low information input. I want you to implement the Clarity Hour. Use this time not just for work, but for meditation, silent walking, or journaling. All without digital devices. This quiet space is where your best insights, those crucial third-order consequences, are often discovered. And go even further with a digital Sabbath. Commit to at least one full day, or even a half day, per week entirely disconnected from all screens. This isn't a luxury. It's a necessity. It restores your attention capacity, which is your ultimate non-renewable resource. So, here is your final action step. It's simple, but it's powerful. To begin building your psychological moat right now, I want you to immediately unsubscribe from 3 non-essential news or media sources. The ones you consume purely out of habit or that nagging fear of missing out. Take this first step today to protect your clarity and secure your future. You've built your psychological moat. You've achieved internal clarity. Now, we enter the final frontier of advanced wealth management, the ability to see global instability not as a risk to be feared, but as a source of immense, asymmetric opportunity. This isn't about just surviving chaos. It's about graduating from hedging geopolitical risk to strategically capitalizing on it. Let's start with the first pillar, the panic premium capture. What happens during a conflict? A trade war? Or a surprise election result? The market panics. People engage in irrational, short-term selling, creating what I call a panic premium. This is a brief window where perfectly good assets trade far, far below their actual intrinsic value. So, what's the fix? It's a strategy I call the disciplined deployment trigger. First, you must pre-allocate cash. This means maintaining a dedicated, slightly larger than usual cash reserve, your cash bridge, specifically for these moments of acute global panic. Think of it as your war chest. Then, you need the intrinsic value test. When a geopolitical shock hits, let's say a regional crisis causes a 10% market drop, you don't panic with the crowd. Instead, you immediately run the affected assets through your value doctrine. You ask a simple question: are these high-quality companies, the ones with strong moats we've talked about, suddenly trading at a 30% discount to the intrinsic value I've already calculated? If the answer is a clear yes, that is your trigger. You deploy your panic premium cash. You become greedy precisely when everyone else is fearful. The second pillar is regulatory arbitrage. Every time a government changes a tax law, an energy policy, or a tech regulation, it creates a new set of winners and losers. The true architect of wealth anticipates these shifts and follows the flow of capital. The fix here is the incentive follows policy mandate. It's simpler than it sounds. First, identify the subsidies. When a major government, like the US or the EU, commits billions to a specific goal, whether it's the green energy transition or bringing semiconductor manufacturing back home, they create massive tax breaks and subsidies. Your move is to invest directly in the companies and the physical infrastructure that are guaranteed to receive those government funds. This is a low-risk, highly asymmetric bet subsidized by the taxpayer. Conversely, you must identify the constraints. When new, punitive regulations are announced, like carbon taxes or strict export controls on certain technologies, you need to divest from the assets that will be negatively impacted before the market fully wakes up and prices in the long-term damage to their future cash flows. This brings us to our third and final pillar, global talent acquisition. This one is often overlooked but incredibly powerful. Global crisis, whether political or economic, often displace entire populations of highly skilled human capital. This tragedy, for some, becomes an asymmetric opportunity for you to acquire world-class talent at a lower cost. The fix is what I call the talent migration protocol. When you see a specific region experiencing upheaval, you strategically focus your hiring efforts there. You can recruit top-tier engineers, designers, or managers for your own businesses or leveraged assets, significantly enhancing your global soft leverage without the premium price tag. And by using the foreign trusts and agile business structures we set up in our earlier discussions, you can onboard this talent quickly and efficiently, placing them in locations optimized for both productivity and tax. So, let's make this real. Here is your final action step for this series. I want you to define one specific geopolitical event that you see on the horizon for the next 12 months. It could be a major election, an ongoing trade policy debate, or a brewing regional tension. Now, pre-commit to a specific dollar amount. Write it down. This is the amount you will deploy from your cash reserves if that event triggers a 15% drop in your target asset class. The amateur fears global chaos. The professional hedges against it. But the architect prepares to capitalize on the predictable irrationality it creates. This is how you secure your legacy? 4 months, we've journeyed together, laying the foundation, erecting the pillars, and crafting the grand design of your financial empire. We've moved from the initial blueprint to the complexities of geopolitical strategy. You now possess a system that is robust, tested, and ready. But today, in this final chapter, we uncover the ultimate truth. Wealth is not a destination you arrive at. It is a dynamic, unending process of perpetual optimization. The greatest architects don't just walk away when the final brick is laid. They become masters of maintenance, evolution, and legacy. This isn't the end. It's the beginning of a higher level game. Our first pillar for this new game is the rate of change audit. In our world, the speed of decay is accelerating. Skills become obsolete, and systems fall into chaos, or what we call entropy. To win, you must not only build, but you must also actively counter this decay. The fix is what I call the weekly Delta Checker. Your clarity hour, that sacred time for reflection, must now evolve. It's no longer just about what you did. It's about no. Change? Ask yourself 3 questions every single week. First, the skill delta. What new high-leverage skill related to your core 1% upgrade did you acquire this week? This is your direct counterattack against skill obsolescence. Second, the system delta. What single point of friction did you permanently remove or automate from your operations this week? This is how you fight back against the complexity trap in system entropy. And third, the capital delta. How much closer is your freedom ratio or net worth divided by your annual expenses to its target? This is your shield against distraction and financial drift. If you are not tracking the rate of change, you are flying blind, and you cannot manage your long-term trajectory. You will be overtaken. Our second pillar is the two-way accountability protocol. Discipline is the engine that drives your entire system forward, and accountability is its fuel. As the chief architect, you demand it from your team. But true leaders understand that accountability is a two-way street. Your team, your advisors, they also need it from you. The fix here is implementing what I call the integrity clock and a formal feedback loop. This means scheduling regular, non-negotiable reviews with your personal board of directors and key employees. Their mandate is to provide brutally honest, unfiltered feedback on your leadership, your recent decisions, and how well you're sticking to your own declared principles. You must be willing to pay to hear the uncomfortable truths. Then, you must personally review your integrity clock. Look back at the recent moments you are tempted to bend your own rules, to chase a deal that compromised your values. This act reinforces your integrity filter, ensuring your moral compass remains your most valuable asset. Without this two-way street, your leadership becomes a dictatorship, and your empire will eventually crumble from within. Our third and final pillar is the enduring legacy of process. Think about this. Your ultimate legacy won't be the final number in a bank account or a trust fund. It will be the operational excellence, the mindset, and the robust processes that you pass down. Wealth is a product, but the system for creating and stewarding it is the true inheritance. The fix is to treat your architect's playbook not as a dusty history book, but as a living gospel. This requires an update. Mandate. The core rules of your empire principles for capital allocation, your strategies for asymmetric investing, your crisis protocols, these cannot be static. They must be reviewed, stress-tested, and updated annually by your family, your successors, and your professional advisors. This forces the next generation to engage deeply with the process of wealth, not just enjoy its product. They learn to think like architects, not just inheritors. They learn to navigate, to adapt, and to build upon your foundation. So here we are, at the end of this series, but at the true beginning of your journey as a master architect. We have given you the ultimate map. We have equipped you with the perfect set of tools. Your final, perpetual mission is to never, ever stop optimizing. The structure is built. Now, the real work begins. Go forth and build, not just for a lifetime, but for generations. We've reached the end. This isn't just another lesson. It's the final synthesis, the absolute creed that separates the temporarily rich from the architects of perpetual wealth. These are the 7 non-negotiable laws, a blueprint for thinking, acting, and living with true financial mastery. First, the law of asymmetric action. Never accept proportional risk. The game is to find opportunities where your downside is small and survivable, but your potential upside is massive, even exponential. You must focus 80% of your energy on building your financial fortress, your defense. The other 20%. That's for offense. For high-leverage moonshots, your job is to find bets where you only need to be right twice out of 10 times, because those 2 wins will pay for all your losses and then some 10 times over. Second, the law of compulsory investment. Wealth isn't built on what you earn. It's built on what you automatically save and invest. You have to pay your future self first, without fail, without question. The moment income hits your account, automate the transfer to your investment funds. This relentless consistency, this discipline, is far more powerful than any attempt to time the market. It's a ritual, not a strategy. Third is the law of soft leverage. Your greatest financial multipliers aren't money. They are time, authority, and knowledge. You should only use money to acquire more of these 3 assets. So, invest relentlessly in upgrading your skills. Use those skills to build systems, to recruit talent, and to create value that isn't tied directly to the hours you work. The goal is to maximize your output per hour, to create nonlinear growth. Fourth, the law of the inner game. Your own psychology is the weakest link in your entire financial system. Fear, greed, and the endless desire for more of these are far more dangerous than any market crash. You must master your mindset. Focus only on what you can control. Your system, your effort. Ignore the noise you can't control. And crucially, separate your self-worth from your net worth. They are not the same thing. Fifth, the law of defensive architecture. The first goal of wealth management is to preserve what you have, not just to accumulate more. You must build the fortress before you go seeking battles. This means maintaining a strong, non-negotiable firewall of liquid cash. It means diversifying your risk across different countries, currencies, and asset classes. You have to plan for the crisis long before it ever arrives. Sixth is the law of value doctrine. Never, ever confuse the price of something with its true intrinsic value. Real financial stability comes from buying high-quality assets when they are undervalued and holding them for the long term. Only invest in assets that have a clear, durable, competitive advantage. And when you spend your capital, always prioritize buying back your time and gaining new experiences over buying disposable consumer goods that lose their value instantly. And finally, the seventh law. The law of perpetual legacy. True wealth isn't measured by the number in your bank account. It's measured by the meaningful impact you create and the wisdom you pass down through generations. Define what your legacy will be. Use your wealth not just to spend, but to fund solutions to real problems. And most importantly, mentor the next generation. Teach them the process of wealth creation. Don't just hand them the money. The system is now complete. The principles have been laid bare. Your final mission, architect, is to execute this creed with unwavering discipline and courage.
The Wealth Architect Epilogue. The Billionaire Blueprint, Real-World Application. The ultimate test of any financial system is its application in the real world. This final chapter shifts from theory to reality, examining how the world's most successful wealth architects, the billionaires, applied the very principles you've mastered. Case Study 1. Jeff Bezos, The Law of Asymmetric Action, Amazon. The principle applied. Asymmetric Risk and Value Doctrine, the story. In the late 1990s, the consensus was that e-commerce was too risky. Bezos launched Amazon, not by focusing on short-term profit, but by focusing on long-term market dominance, the moat. He constantly reinvested profits into infrastructure, warehouses, servers, logistics, to achieve an unassailable cost and efficiency advantage. The architect's insight. Bezos practiced the law of asymmetric action. He knew the maximum loss was the failure of the startup, limited downside, but the maximum gain was owning the entire market for retail, unlimited upside. He invested based on intrinsic, long-term customer value, ignoring the initial high cost, low stock price, and lack of short-term profit. He built a system, massive logistics network, that competitors simply could not replicate. Case Study 2. Warren Buffett and Charlie Munger, The Law of Defensive Architecture, The Principle Applied, Defensive Architecture, and Value Doctrine, the story. The core of Berkshire Hathaway's success is not aggressive stock trading, but defensive financial structure. Buffett built his fortress using permanent capital from insurance float money he holds for free until claims are paid. This free capital is the ultimate financial firewall and allowed him to buy assets cheaply during every major panic, the panic premium capture. The architect's insight. They mastered the law of defensive architecture. They were ruthlessly patient and only invested when assets were trading far below their calculated intrinsic value margin of safety. Their system ensured they always had cash when everyone else was desperate, the ultimate expression of asymmetric patience. Case Study 3. Elon Musk, The Law of Soft Leverage. The Principle Applied. Soft Leverage and Innovation Portfolio, Episode 38. The story. Musk succeeded by applying high-level knowledge and first principles thinking to seemingly unrelated. Established industries, aerospace, automotive, energy. His expertise in physics and engineering became the soft leverage that allowed him to see solutions others missed. He attracted top talent by selling a compelling, massive vision legacy metric. The architect's insight. He maximized the law of soft leverage. His greatest investment was in knowledge transfer and talent acquisition. He used his vision authority, legacy, to acquire human capital and government support. Leveraging those non-monetary assets to build the innovation portfolio companies that created entirely new markets. Epilogue, the final summary. Every great fortune is built on a simple foundation, perfectly executed. Find your asymmetric play. Fund it with compulsory discipline. Defend it with non-negotiable systems. Guard your mind against the market's noise. The architect's journey is not about the amount of money earned, but the mastery of the process of creation. The series is now truly complete. Go forth and build your masterpiece.
The architecture's finished. Now, begin the work. Thanks for watching. Subscribe for more.